on the first one. So here's China suddenly decided it wants a whole lot more iron ore and coal. Short run, quantity of mining production can't respond. Very low supply elasticity. So about all that happens is the price of mining products goes up. Big increase in the price of mining products. So that's a massive increase in export revenue. And if you think of Australia between about 2003 and 2010, mining income went from about 25% to nearly 60% of our export revenue. Massive increase in income. And assuming nothing else changed, that would cause us a big appreciation. Now, what might offset it? Well, if all that increase in income was owned by foreigners and went out as an increase in NYT, net income transfers, then it would square away and there'd be no net effect. Or if all that income was squirreled away as domestic savings, either by the government with 100% tax, or the company storing it away and not putting out in dividends, again, you'd roughly get the offset. The reality is that a lot of that income gets spent. Government takes about 40%. 30% corporate tax rate, and then the states are taking about another 7 or 8% in royalties, and then you throw in a little bit of other taxes. You're getting close to 40%. It's snaffled by the government. Now, government could save it, SG, but we don't find governments that do that. Although arguments, if you were to have a sovereign wealth fund, a la Norway and some of the Middle East, then that's one way of doing it. Or they can give it as tax cuts, which is pretty much what the Howard Costello government did. Threw it away. Or they could put it on their own expenditure, which is essentially what Rudd and Gillard have done. Now, to the extent that that government and private expenditure goes on other imports, MO, or a reduction of Australian exports, we buy more food here, we buy more education here, then that modifies the magnitude of the appreciation. But the reality is the mining boom was a big increase in net income. A lot of that was spent on non-tradables, and so the net effect is a substantial currency appreciation. So that gives us a nice simple story. Terms of trade go up, currency appreciation. All that stuff in the literature is fabulous. That's good. But as a good salesman says, there is more. There is the investment stage. So now the first round of effects is there's a whopping increase in investment in the mining sector. IM. And the reality is most of that's funded by imports. By overseas borrowings. Debt or new equity. So a big increase in capital inflow. Now, if all of that investment was foreign, that is, we totally bought the gas wells and the railway lines from overseas, then there would be an offsetting increase in imports of mining equipment, and it would wash out. But the reality is in Australia that we produce about half, on average, of that mining investment. So that gives us a substantive net appreciation effect. Now, there's also a bit of an income effect here. The mining boom picks up some underemployed people. A few people come in on 4, 5, 7 visas. A bit of extra capital comes in. And a lot of people move from low-paying, tradespeople on Melbourne and Sydney earning 80 grand a year and go to the mining sectors and earn 200 grand a year.
Did you say low?
Yeah, well, they're suffering, these guys. Yeah. Yes, they're doing pretty well to start off with, and they're doing even better. So there's a net increase in income. Some of that goes to imports, etc., etc. That's a partial offset. Now, what's kind of interesting in this about, there's a further appreciation of the exchange rate, but there's no change in the terms of trade. So here's the first point of saying there isn't a simple relationship between the terms of trade and the exchange rate. So what if we go on a decade or so and we get an increase in production? So that's sort of 2008 onwards, where this investment starts to enable us to increase production. Well, what happens to mining export revenue? The term QM, PM. Well, the quantity of exports goes up, QM. That's what the production stuff does. But what happens to the price? Well, if we think of a supply-driven boom, Australia is a small contributor to the total world. The demand is clearly elastic. Most models have it 0.6 to 0.10, not 0.6, 6 to 10. So the increase in quantity dominates the increase in price. There's clearly an increase in mining export revenue. But in the case of a demand boom, not only has Australia increased production, but so has Indonesia and Canada and the US and every other damn country. The demand curve shifts down. It's now conceivable that the reduction in price is greater than the increase in quantity. Export revenue actually falls. And we can set up the conditions for that. But there's no guarantee they're going to increase. So it's possible with a demand increase boom that as we go from the investment stage to the production stage, export revenue will actually fall. But it'll still be worth having. And it'll still be an increase relative to pre-boom times. As we also go from the investment stage to the production stage, we don't have the investment. So there's no draw, the IM is reversed, and the imports of mining equipment is reversed. So that has a depreciation effect. We also have to repay those overseas borrowings. So that net income transfer term, NYT, goes up. That pushes the current account into deficit, towards deficit. That has a depreciation effect. And then we have some second round effects. Assuming income goes up, then not all of that will be on non-traded. Some of that will be on other imports, other exports, and tax savings, vice versa. So we now end up with, we're not quite sure what's the net effect on the exchange rate. There are some positive and some negative. Unfortunately, when I presented this in Sydney, I ran out of time, and I hadn't thought any further, and that was the end of the story. For my sins, I thought about it a bit further and said, let's consider the production stage versus the pre-boom. So the production stage, we've got, relative pre-boom, we've got an increase in the quantity of mining. We've had a change in the price, but that's going to vary. For demand shift, aggregate demand shifted out against a fixed supply curve, the world price has gone up. On the other hand, for a supply-driven boom, demand hasn't shifted, but we've had a brand new supply outward shift for us. Price actually falls. But because of the elasticity of demand for Australia as a small country, total export revenue goes up. All the investment and all that stuff's not going on in this comparison. But we're paying out some of that extra income to foreigners who funded it. So there's a deduction for net income transfers. But that's clearly going to be less than the net increase in gross income. So we're going to get a net improvement in the current account. So that's going to push for an appreciation. But note that the terms of trade has varied. With the demand boom, the terms of trade's gone up, the exchange rate's gone up. For the supply-driven boom, the terms of trade's gone down and the exchange rate's gone up. There are subtle differences. And arguably, a lot of Australia's previous mining booms, going back to the 1850s gold, perhaps the 1970s iron ore and coal, were actually supply-driven booms. And yet these guys are finding studies of positive relationships between the terms of trade and the exchange rate. There's something a little bit fishy. The challenging one is to compare the production stage with the investment stage. And if you like, that's a bit like comparing Australia in 2015 with Australia now. There we got lots of things moving. We've got the increase in quantity of mining. Prices will probably decrease. But mining exports are going to increase for the supply-driven boom because of the elasticity of demand, but they may decrease or increase for the demand boom. Depends how much the rest of the world's supply reacts relative to Australia in driving that story. So that could give us an appreciation or a depreciation effect. We got the reversal of the investment phase, so that's giving it a depreciation effect. We got repayment of non-resident borrowing, that's a depreciation effect. Second round effects depend on the income. So we've got some appreciation and some depreciation effects, and we don't know what happens to the exchange rate. It can go up or down. So one really needs then to get off my theorising model and start to build a quantitative model to put this story together. And so to bring all this stuff together, the effects of the exchange rate, both the direction and the magnitude, is not a nice simple relationship with mining booms. It depends on whether it's supply or demand driven boom. It depends on who's funding it. It depends on who's providing the investment. And it depends a little bit on what we do with the income benefits. Do we save them, or do we spend them on non-traded or traded goods? And ultimately, you're only going to solve that with a comprehensive CGE model. Now, I dare say that Adrian Pagan and some of these bloody time series guys will tell me they can fit all this stuff together in their variable autogressive models with restrictions, without restrictions. It's possible, but I think you've got to think carefully about what's driving the error terms. So if you look at those models at the moment, they're essentially saying if the terms of trade go up, the exchange rate goes up. I'm arguing that that's not necessarily the case. So that's it, Dave.